In 2008, a 158-year-old bank called Lehman Brothers collapsed in a single day. And in doing so, it didn't just bankrupt itself. It crashed the entire global economy, vaporized $10 trillion in market value, and made your parents question the idea of retirement. Why? Because a bunch of guys in suits thought betting everything on risky loans and bad math was just good business. This is the story of how Wall Street's golden boy became America's biggest financial corpse. Lehman Brothers started in 1850. That's right, before light bulbs were a thing. They began as a humble dry goods shop in Alabama. Fast forward a few decades, and they were power players in the stock market, helping fund railroads, GM, even the U.S. war effort. By the 2000s, they were the fourth largest investment bank in the U.S. They managed $600 billion in assets, with a swagger like they were too big to fail. Their secret weapon? Mortgage-backed security. Think of them like financial smoothies made of chopped-up home loans. High-risk loans got mixed in with decent ones, and voila! The whole thing got rated AAA, as safe as U.S. Treasury bonds. Except it wasn't. Let's rewind to the early 2000s. Interest rates were low. Credit was easy, and banks were high on giving out subprime mortgages, loans to people with terrible credit scores. Did you have a job? Didn't matter. Proof of income. Optional. Breathing. Congratulations. Here's a $500,000 house. Lehman wasn't just participating. They were obsessed. They bought subprime mortgage companies like BNC Mortgage and Aurora Loan Services, doubling down on housing risk. They called it innovative finance. In 2006, housing prices peaked. By 2007, the party was over. People started defaulting on mortgages. Home values plummeted. Lehman's assets, built on millions of subprime loans, turned to garbage. Their debt? $613 billion. Their actual value? Less than the furniture in their office. Lehman stock went from $86 to 21 cents in under a year. Creditors backed off. Rumors spread. It was a full-blown Wall Street horror movie. Lehman begged the U.S. government for a bailout. After all, the feds had just bailed out Bear Stearns and Fannie Mae. But this time, Treasury Secretary Hank Paulson said no. Why? He wanted to teach Wall Street a lesson. Let one giant die and the others would learn to behave. Spoiler, they didn't. No one bought Lehman. No one bailed them out. So on September 15, 2008, Lehman filed for Chapter 11 bankruptcy, the biggest in U.S. history. Hence, Lehman fell. It was domino time. Markets crashed. The Dow dropped 777 points in one day, a record. Banks stopped lending. Small businesses couldn't get loans. Pension funds collapsed, and millions lost jobs, homes, and savings. The government went full panic mode, creating the TARP bailout fund, $700 billion, cutting rates and nationalizing parts of the financial system just to keep it breathing. Meanwhile, Lehman execs still got paid bonuses. The damage? $10 trillion erased from global markets. 8.8 million Americans lost their jobs. 6 million homes foreclosed. Global trust in banks? Gone. And the people responsible mostly got new jobs, book deals, and private jets. Because in America, too big to fail also means too rich to jail. Lehman was the fall guy, the sacrificial lamb of capitalism. But the system that enabled it? Still running, still risky.